This is not financial advice, and I am not a financial advisor.
This is just me talking about my personal financial journey. This is for entertainment purposes only.
Enjoy the show.
So, imagine holding this official piece of paper that unequivocally states you are worth $500,000.
Right. I mean, that sounds fantastic.
Yeah, it looks great on paper. You feel this profound sense of accomplishment, but then a sudden medical emergency hits. Or maybe a once-in-a-decade market opportunity opens up.
Oh, and that's when reality sets in.
Exactly. You realize you cannot spend a single cent of that $500,000 without spending months asking some institution for permission to access your own money.
It's wildly frustrating.
So today, we are basically tearing down the illusion of the modern middle-class dream. Welcome to the deep dive. We're exploring a framework today that completely flips conventional financial wisdom on its head.
It really does. We're dissecting a highly provocative, even, uncomfortable premise today.
Yeah, the premise is this. Is it actually structurally easier to build independent wealth than it is to join and maintain your standing in the modern middle class?
Which just sounds incredibly counterintuitive, right?
Right.
I mean, from our earliest days in school, the psychological blueprint, we're handed associates independent wealth with massive untethered risk.
Right. And the middle class is supposed to be absolute safety and predictability.
Exactly.
Mm-hmm.
But when you move past that cultural narrative and actually break down the mechanical realities, the sheer math and the daily energy required to secure a solid middle-class standing in today's economy, the data tells a vastly different story.
Okay, let's unpack this because the stakes here are massive. If we have been operating on a flawed blueprint, it changes how you should be investing your time, your education, and your energy right now.
It changes everything.
So to understand why this framework argues that independent wealth might actually be the path of lesser resistance, we have to start by looking at the specific structural friction of the traditional path we have all been told to follow.
Yeah, we really need to analyze what we call the gatekeeper bottleneck. Let's look closely at the modern middle-class high earner.
Like, what income bracket are we talking about here?
Specifically, someone pulling in between, say, $90,000, $120,000 plus a year. Culturally, this is the bracket that signifies you have, made it into a comfortable, secure lifestyle.
Yeah, you've got the good salary, the benefits.
Right. But the reality of entering and maintaining that specific bracket is an absolute grind.
It's an obstacle course just to get to the starting line.
It is a multi-layered, heavily fortified obstacle course. First, you face the barrier of entry, which is multi-year degree requirements.
And the massive compounding debt that usually comes with them.
Exactly. And then once you finally have the credential, you step into this increasingly labyrinthine hiring structure. You're no longer just handing a resume to a manager who can evaluate your potential.
Oh, no, you have to survive the machines first.
Right, the automated HR algorithms, these applicant tracking systems that instantly filter you out if you lack a specific keyword or if you have a non-traditional gap in your employment history.
Which is terrifying because a human never even sees your application.
Yep. And if you somehow make it past the machine, you face a gauntlet of corporate hiring managers, behavioral assessments, and just endless interview rounds.
The way I visualize this, it's like trying to climb a permission-based career ladder. At every single rung of that ladder, there is a third party standing there holding a clipboard.
Oh, that's a great way to put it.
Yeah, and they are the ones who get to look at you, check their little boxes, and decide if you are allowed to move up to the next rung. You have to ask permission to earn a higher salary.
You ask permission to take time off to care for your family.
Exactly. You ask permission to take on a new project that actually interests you. It's all permission.
And that clipboard holder represents the institutional gatekeeper. Your entire financial security becomes completely dependent on their subjective evaluation of your worth.
Which is exhausting.
It is. You spend an enormous amount of your cognitive bandwidth simply managing their perception of you. You are constantly playing defense.
But let me push back on this for a second. Because if we're looking at this from a traditional mindset, isn't that clipboard and that HR bureaucracy actually providing essential stability?
Well, that's the argument, sure.
Right, because the open market is a bloodbath for most people. Most new ventures fail. So we are taught that you tolerate the corporate politics and the gatekeepers because they shield you from risk. How is abandoning that ship for the direct market actually less risky?
Well, this raises an important question. Is that predictability actually shielding you from risk, or is it just masking a much deeper fragility?
Masking fragility, I like that.
Because the friction of the middle-class path isn't just the sheer exhaustion of constantly seeking permission.
Yeah.
The fundamental mechanical problem is the cap itself.
The income cap.
Yeah. When you are in the traditional middle-class structure, your income is heavily and inextricably capped. You are locked into a direct trade-off of your finite time for wages.
An hour of work equals an hour of pay. The ultimate one-to-one ratio.
Precisely. And it doesn't matter how hyper-efficient you get at your job, or how brilliant your insights are, or how aggressively you climb that permission-based ladder.
Because your physical time is strictly finite.
Exactly. The corporation knows this, the HR algorithm is programmed around this, and the salary bands are explicitly built to manage it. Your earning potential is mathematically constrained by the limits of human biology.
You literally hit a ceiling that no amount of late nights or corporate politicking can break through.
Right, because you simply cannot manufacture a 25th hour in the day to trade. You are trading a non-renewable resource, your time, for a highly regulated return.
Which brings us to the crux of this entire argument. If our time is strictly finite, and the corporate ladder fundamentally caps our earning potential based on that time, how do we decouple our income from the hours in a day?
That is the million-dollar question.
Yeah, where else can we take our energy? Because if we aren't trading time for a capped wage, we need an entirely different mechanism for generating wealth.
We need to bypass the clipboard entirely. This is where we step away from institutional bottlenecks and enter the direct market path.
Okay, the direct market. Define that for us.
This path focuses on building independent wealth through mechanisms that do not require third-party permission. So, acquiring assets, executing investments, active trading, and scaling small businesses.
Got it.
The absolute core difference here, the defining feature that separates it from the middle-class ladder, is the complete removal of institutional gatekeepers.
There's a no hiring manager to charm.
No HR algorithm filtering your life experience. You are operating face-to-face with the market itself.
Face-to-face with the market. And we have to be honest, the open market is an entirely ruthless judge.
Oh, it is brutal. But crucially, it is an entirely objective judge. It does not care who your parents are. It does not care about your Ivy League degree.
And it certainly doesn't care about your ability to navigate office politics or pretend to look busy in a mid-year performance review.
No, not at all. What's fascinating here is that the direct market only evaluates two specific metrics: value delivered or capital deployed.
Value delivered and capital deployed. Let's break those down, because that sounds like economic theory, but it dictates everyday reality.
Yeah, think of it as an input-output mechanism.
Yeah.
If you create a product, write code, or offer a service that efficiently solves a problem for a group of people, that is value delivered.
And the market pays you for the solution, not the time it took.
Exactly. The market compensates you based on the scale and impact of that solution, not how many hours it took you to build it. Conversely, if you analyze a market inefficiency and allocate resources into it, that is capital deployed.
So making investments.
Right. The market yields a return based on the accuracy of your allocation.
Here's where it gets really interesting, because that ruthless objectivity is incredibly liberating. It strips away all the performative baggage we spend decades perfecting.
It absolutely does.
So, if we don't have to spend years crafting the perfect resume or figuring out how to charm a corporate hiring manager, how does someone actually transition? Like, how does relying purely on capital deployed or value delivered change the way we invest our energy on a daily basis without already being wealthy?
It changes everything because it completely reallocates your energy from playing defense to playing offense.
Playing offense.
Yeah. In the traditional model, a staggering percentage of your daily energy is spent just maintaining your position on the ladder.
Yeah.
You are sitting in performative meetings to prove you are engaged.
Oh, so many meetings.
You're meticulously documenting your work to justify your salary to the person with the clipboard. You are managing office perceptions. None of that friction produces actual wealth.
It just maintains your permission to stay employed. You are exhausting yourself managing optics instead of creating actual leverage.
Exactly. But when you shift your mindset to the direct market, all of that wasted cognitive load is reclaimed. You take the thousands of hours you would have spent commuting or sitting in useless meetings or navigating workplace drama.
And you pour it directly into building an engine.
Yes. You create a piece of digital equity. You refine an algorithmic trading strategy. You scale a niche service business. Your energy goes straight into the mechanism that actually generates wealth.
Because you aren't trading time for wages anymore.
Right. And there's a concept we need to introduce here: asymmetric leverage.
Asymmetric leverage. Tell me how that works in this context.
Asymmetric leverage means that your inputs and outputs are no longer correlated on a one-to-one basis. If you spend 50 hours building a digital tool that solves a workflow problem and you deploy it on the open market, it can be purchased by 10 people or 10,000 people.
The 50 hours of input remains the same.
But the output scales infinitely without requiring more of your physical time. You have detached your earning potential from the ticking clock. That is value delivered at scale.
And what about on the capital side?
On the capital side, deploying $10,000 into a highly liquid, well-researched market position can yield returns that outpace an entire year of a capped middle-class salary.
Wow. It completely reframes how we view work. You're building systems instead of renting out your hours.
Exactly. You own the system.
But if this direct market path changes how we generate wealth, it also completely upends how we measure it. And this leads us to exposing the massive illusion at the center of the middle-class dream.
Oh, the network illusion.
Yeah, we have to talk about how people calculate their net worth because the math is deceiving us.
This is perhaps the most critical distinction to grasp. It's the stark mathematical reality of total net worth versus liquid net worth.
Because the traditional middle-class dream is heavily, almost exclusively focused on total net worth, right? Which is usually driven by home ownership.
Right, we are taught to buy a house, pay down the mortgage, and watch the value go up on paper.
The classic white picket fence. You check your Zillow estimate and feel like a financial genius.
Exactly. But let's look at a very specific scenario. Take a traditional middle-class family holding $150,000 in home equity.
Okay, decent equity.
On paper, their total net worth looks highly respectable. They feel secure, they feel they have achieved the blueprint. But mathematically, this family is highly illiquid and incredibly fragile.
Because all that wealth is literally trapped inside the drywall of their house.
Exactly. They might have 150 grand in equity, but they are likely sitting on under $15,000 in actual accessible cash.
Wow, that's a huge disparity.
It is. What happens when the system shocks them? If a major medical emergency occurs, or if the primary breadwinner loses that permission-based job.
Or, just as importantly, if a sudden asymmetric opportunity arises in the market.
Right, they cannot access that $150,000. To get to their own wealth, they either have to sell their home, which takes months and costs a fortune in transaction fees.
Or they have to go back to a gatekeeper.
Yes. They have to go to a bank and beg for a home equity line of credit. They are asking for a loan against their own wealth.
So even with their own money, they are still forced to ask for permission.
They're forced right back to the clipboard. The illusion of safety shatters when you realize your wealth is permissioned.
You know, it's like having your wealth tied up in a massive cargo ship.
A cargo ship.
Yeah, think about it. Yes, that cargo ship carries immense value. It gets you across the ocean. It provides very real utility, just like a house provides shelter and saves on rent.
Okay, I follow you.
But if you are at the helm of that cargo ship and you spot a massive storm ahead, or if a completely new, faster route suddenly opens up, you cannot just pivot.
No, the cargo ship takes forever to turn.
Exactly. You cannot maneuver a cargo ship like a speedboat. You are locked into your trajectory, entirely at the mercy of the momentum you've already committed to, and totally unable to adapt to changing conditions.
That is a brilliant way to frame it. The cargo ship has utility, but it possesses zero agility. Now, contrast that highly fragile scenario with an individual operating in the direct market with $100,000 in purely liquid assets.
So cash, stocks, things like that.
Exactly. We're talking about cash, self-custodied capital, tradable securities, or digital equity that can be liquidated instantly.
So on a spreadsheet, they actually have a lower total net worth than the family with the house.
Lower total net worth, yes. But they hold vastly more operational freedom. This person is not fragile.
Right, because they can actually move.
If they lose a revenue stream, they can survive for years without panicking. If the market experiences a sharp downturn and presents a generational buying opportunity, they can deploy capital immediately.
They have total leverage.
They do. They don't need to schedule a meeting with a bank manager to approve a loan, and they don't need an HR department to approve their salary.
They aren't waiting for a gatekeeper to unlock their vault.
Right. If we connect this to the bigger picture, liquidity is the ultimate form of defense and offense combined. It is the agility to survive sudden macroeconomic emergencies without your daily life falling apart.
And the immediate leverage required to seize direct market opportunities when they present themselves.
Exactly. When you achieve permissionless liquid autonomy, you dictate your terms to the market, rather than letting an institutional gatekeeper dictate their terms to you. You are insulated from the friction and the artificial caps of the middle-class trap.
It fundamentally changes your posture in the world. Think about the psychology of it. When you are illiquid and you are relying entirely on a capped salary, you walk into every room needing something from someone else.
Always asking.
Yeah, you need the job offer, you need the mid-year promotion, you need the loan approval. You are perpetually in a state of asking.
But when you are liquid,
When you are liquid and you operate in the direct market based on value and capital, you walk into the room with leverage. You aren't asking for a seat at the table, you are building your own table.
and that circles us all the way back to the core premise we started with. Is it actually easier to build independent wealth than to join the modern middle class?
When you tally up the immense compounding friction of the middle-class path, the debt, the algorithmic resume scanners, the corporate politics,
The hard mathematical cap on your time and earnings.
and the ultimate fragility of tying your entire net worth up in an illiquid asset, the daily energy required to sustain that illusion of safety is staggering.
It really is. The direct market is ruthless, yes, but it is a direct line.
It is a direct line. While the open market requires discipline and an entirely different skill set, it offers a clearer, uncapped, permissionless route. You focus all your reclaimed energy on delivering value or deploying capital, and you maintain your maneuverability through liquid assets.
You stay in the speedboat, essentially.
Exactly. So what does this all mean for you? If you look at the architecture of the modern economy through the lens of this framework, the blueprint we've all been handed might not just be outdated, it might be structurally flawed.
Highly flawed.
We see that trading your finite time for wages leaves you permanently vulnerable to third-party permission. We see that the direct market removes the clipboard, operating purely on objective output.
And perhaps most importantly, we see that true, undeniable operational freedom does not come from a bloated, illiquid net worth based on home equity.
No, it comes from liquid autonomy. The agility to navigate the world and deploy capital on your own terms, it really makes you reevaluate everything we've been taught about playing it safe.
It definitely shifts your perspective.
Which leaves us with one final thought for you to mull over as you look at your own career trajectory, your daily energy expenditure, and your balance sheet today. If operational freedom, resilience, and true leverage only come from liquid autonomy, is the traditional, safe, middle-class path anchored by an illiquid house and a permission-based salary actually the riskiest financial position you can hold in a rapidly changing world?
That is the question to ask yourself.
Thank you for joining us on this deep dive. Take a hard look at your own liquidity and where your energy goes this week. We'll catch you next time.